Welcome to the History of LIHTC and the Tax Code, presented by Don Bernards from Baker Tilly. In this video, you'll learn about the history of LIHTC and the tax code. You'll also explore the forces that led to the creation of the low-income housing tax credit known as LIHTC, one of the most influential tools for financing affordable housing in the United States. Enjoy!
The onset of the public housing program began in the 1930s. After World War II, demand continued to increase, as did production. However, in the 1960s, investment in public housing declined, and there was an effort to shift affordable housing to the private sector. In 1969, the Tax Reform Act was passed, which included tax breaks for investment in affordable housing. However, this program was highly susceptible to fraud. It also highlighted the complexity of incentivizing private investments.
To understand the history of the low-income housing tax credit program is really to understand the history of housing policy in the United States. As we all know, the main form of housing development was public housing, and that was in the 40s, 50s, 60s, and so forth. And then for various reasons, the development of public housing effectively came to an end of new construction of public housing and those subsidies. The idea was to try and shift the investment to the private sector. Can the private sector provide? There's this act, Tax Act in 1969, which was giving tax breaks for investments from private investors. It kind of showed the complexity of incentivizing private investment. It was subject to fraud. It really didn't work too well. And so we had a lack of affordable housing development. We needed something new.
In the mid-1970s, direct subsidies for construction and rehab of affordable rentals were passed as part of the Section 8 program. In the 1980s, federal spending was reduced for affordable housing programs like Section 8. Tax rules were changed to encourage wealthy individuals to invest in affordable housing developments, but that plan failed. As a result, there was a decline in new construction of affordable housing during this time.
In the 1970s came about the program that I'm sure many of you are familiar with, Section 8. Section 8 contracts that came to project levels, direct rental subsidies for construction and rehab. And we'll see in a few slides a chart. We had more production of affordable housing in the 1970s than any other time period over a 50, 60-year history. Well, that kind of came to an end. We hit the 1980s, trickle-down economics, reduced federal dollars for lower-income families, and severe Section 8 cuts to the Section 8 program. So production, again, of affordable housing slowed down. There was a tax rule for additional write-offs for higher-income individuals, but again, that didn't work. There were more higher-end apartments being built, but again, there was a drop in affordable housing production.
Another Tax Reform Act was passed in 1986, and this included the birth of the modern-day LIHTC legislation. In the 1990s, many supporters from the affordable housing community and corporate investors came together to produce affordable housing opportunities, which was an initial success for the program.
Then came really this watershed moment in affordable housing production, the Tax Reform Act of 1986, what we'll call the birth of the modern LIHTC legislation. It was really going to be a stopgap. How do we get affordable housing development going? But we saw over the years, from 86, 87, 88, it was doing well. It was producing units. There were a lot of supporters around the affordable housing community saying, hey, this could work. This is providing what we want to, housing to lower income families. And it brought corporate investors, so more structured finance, into the program rather than individuals, which, as we could see before, was a little bit messy. There was some initial success in the late 80s and early 90s.
The LIHTC program was renewed annually until the Omnibus Budget Reconciliation Act of 1993 made it permanent. The LIHTC program is increasingly integral to the delivery of affordable housing.
Then, because of enough success, the low-income housing tax credit program became permanent in the tax code in 1993. Again, it was efficient. It created units that met, renting to persons of 60% or less of the area median income. That's what the program was intended to do. It was very well underwritten and safe. It has a very low foreclosure rate. It has the lowest foreclosure rate of any real estate asset class, including market rate family housing. So very safe. It brought equity investors. It brought debt to the table. It now allowed organizations to really ramp up production. And again, we'll see the production in the 90s into the 2000s was kind of like a line like this, very, very steep line up in housing production. Because now I could create programs. If I'm a developer, I can now say, hey, I know tax credits are going to be there next year and 5 years from now. Investors could line up and get more equity going. Lenders could get programs, state agencies, so everyone could get programs going. And that was really the moment, 1993, that really shot this program in overdrive. This program that we saw was efficient. It was really a true public-private partnership for the first time. We had corporate investors as opposed to individual investors. We had programs that set projects up for success with compliance, with professional management, and so forth. We did have enough compliance and rules to follow. One thing that I think is very interesting is this asset class, low-income housing tax credit, affordable housing, has the lowest foreclosure rate of any real estate asset class out there. We think of like hospitality, hotels. We think of market rate apartments. We think of light industrial, commercial, anything. These projects are so well underwritten. Again, it started in 1986, almost 40 years in the program. It has the lowest foreclosure rate. So thinking about the safety, the long-term viability of these projects, again, one of the reasons, even in 1993 already, that the government decided to make it a permanent program. As I noted, in 1986, this was kind of bridge the gap in affordable housing. Again, how will it work? Luckily, this program, since the beginning, has had broad bipartisan support. Whenever there's been amendments, possible changes, possible increases to the amount of credits and so forth, making it easier to access, there's been strong bipartisan support in Congress. We see bills typically 50-50 Republican and Democrats supporting the program. And it's actually evolved to create over 3 million units plus over the almost 40-year history of the program. Annually, it's over 125,000 units are created with the program. We talk about various acronyms, and I think in affordable housing, we have so many acronyms, it's kind of alphabet soup. But I've already mentioned low-income housing tax credit, or LIHTC, LIHTC, LIHTC. You also hear many times Section 42, and that's because that's the tax code in 1986, the Tax Reform Act of 1986. It was written in Section 42 of the tax code, so you can pick up a big tax manual and binder, and you'll find Section 42. And again, the premise of this program is bringing large corporate investments in exchange for tax credits into these projects. And we'll kind of talk about the essence of the program. So how does the federal government and states work together to bring around this Section 42 program, the low-income housing tax credit program? As we talked about, Section 42 authorizes the credits, and it operates under the administration of the state housing agencies as regulated by the IRS. Every state in the country has a state housing finance agency, and the beautiful thing is we have these standards through Section 42 that we comply with, but allows states then individually to tailor to the needs of their state. What type of housing do we need? Family housing, senior housing, supportive housing, what part of the state, near what amenities, and so forth. So we have overall guardrails and guidelines through the federal government, but yet states can use their own needs to kind of tailor the program to what they need. Again, why this helps the overall program in the country is because we have lenders, we have investors that work in all 50 states. Developers can work from state to state, and having this standard in place allows us to move easily from state to state, even though there are nuances, as we'll see, between the states. As I noted, kind of this program is an indirect subsidy, so to speak, because whereas Section 8, right, there's a direct rental assistance to the project, this is actually bringing in tax credit equity, and it's a very flexible program. Again, can be used for, and we'll get into a little bit more detail later, but for new construction and rehabbing existing apartment or converting a historic building. So a very flexible program to bring about much needed affordable housing. This is just a chart of what I've talked about in the history of low-income housing tax credit and other affordable housing production over the years, over the last 50 years. I'll point out just a couple quick things. You can see the big spike of housing production in the 1970s. That was Section 8 housing. The Section 8 contracts going for new construction or renovations. You can see in the early 80s, housing production dropping again, trickle-down economics not really helping our affordable housing. Then that big increase, the big ramp, is once low-income housing tax credit became permanent in 1993. And you can see from the early 90s all the way into the 2000s, all the way to the recession, that big drop there in 2008, 2009 is a recession. But from 93 to 2008, we saw for the most part a straight ramp up. Again, people were understanding the program. It was safe, it was productive, it was doing really what housing policy wanted to do it, what housers wanted, creating a quality, affordable housing. Again, the credit is the key to providing rents that are affordable. And what do I mean by that? Again, just real quickly with a credit is literally a dollar for dollar reduction in someone's tax liability. And you think of the large investors in this program are banks, large insurance companies, large C corporations that have literally millions, hundreds of millions of dollars of tax liability. So they'd be looking to acquire these tax credits. And the whole essence of the program, the whole indirect subsidy essence, if we think about the old adage when you were buying a house, you'd put 20% equity down and you'd have an 80% mortgage. Well, as we'll see in these low-income housing tax credit projects, the amount of equity that might come into a project from, if you will, the sale of these tax credits is anywhere from 30 to 60% of total project costs. Well, I'm going to have a far less smaller mortgage, right? Not 80%, but maybe I need a mortgage of only 30% or 50% of my project. With a lower mortgage, that leads to lower debt service, lower annual and monthly debt payments, like your mortgage payments. With less debt service, then I can have lower rents. And we'll kind of get into a lot more detail on that. But that is the essence of the program. More equity, lower mortgage, lower rents. That is the essence of the program. And just real briefly, how do the credits flow then from Section 42, the federal government, to an investor? And this is just kind of a flow chart and it kind of talks about a lot of these stakeholders we already touched on. The federal government, under Section 42, allocates tax credits to every state and actually our territories as well. The states then have qualified allocation plans to allocate the tax credits. Developers many times through competitive processes apply for these tax credits with the projects that they want to develop in their communities. If they're awarded, they receive the tax credits and they form a partnership, a legal entity, with the tax credit investor. So now we've gotten the tax credits all the way from the federal government down to this partnership, and those tax credits then flow on a tax return, if you will, to their corporate investors. And the corporate investors, in exchange for those tax credits, will put the equity into the partnership, and which pays for project costs, construction, architect fees, and interest, and things of that nature. So again, the flow of the tax credits.
Thank you for joining HEI Group's Housing Training Institute. Be sure to check out our complete course, The Fundamentals of LIHTC, available now. You'll also want to keep an eye out for the next course in our LIHTC series, LIHTC Project Underwriting, from Concept to Completion, along with additional courses and certifications on this topic. Visit www.housingtraininginstitute.com to explore our full collection of training resources for housing professionals.